If I had to think about one thing that really scares me, that's it. You see a circumstance where if the Fed doesn't intervene, the interest rate wants to go higher. It wants to go higher.
The worst case scenario for gold would be that the Fed doesn't do anything, because I don't think they're going to raise interest rates. That would obviously be the worst case, but I think the worst scenario is that the Fed does nothing, and the best scenario is that they start cutting rates towards the end of this year, because what I see is the rate of change of inflation is going to be going down. When Warsh assents to the inevitability that he has to print trillions of dollars, then I think you're going to see gold shatter its all-time previous highs and go towards $10,000 an ounce.
The global economy stands at a precarious crossroads where central bank decisions carry unprecedented weight for investors worldwide. As the Federal Reserve navigates an intricate web of persistent inflation, fluctuating interest rates, and soaring national debt, traditional market dynamics are facing severe distortion. Rick Rule, a leading resource investor, and Michael Pento, a prominent macroeconomic analyst, emphasize that the financial system faces deep-seated structural risks due to prolonged monetary manipulation. They predict that the rate of change for inflation will decline toward 3% or lower later this year, driven by a contracting Federal Reserve balance sheet and slowing money supply growth. However, this disinflationary trend will merely mask a more profound reality, a lingering environment of intractable stagflation with minimal real growth. They predict a severe liquidity crisis could strike by late 2026 or 2027, forcing an inevitable turn to massive money printing that will ultimately drive gold to shatter past highs toward $10,000 an ounce. To protect capital, Pento has recently doubled his allocation to physical gold and established new positions in gold miners, anticipating that falling nominal and real interest rates will catalyze a major bull run. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I always hold 5% physical gold, and then I toggle what I call liquid paper gold between 0 and 20. And I very recently, right after Kevin Warsh gave his speech, I said, this has got to be the bottom for gold. And I doubled my gold exposure, and I actually took a position in miners for the first time in a very long time. And they were down like 35% since the February highs, and gold was down like 20%. So I say this idea that Kevin Warsh is now going to aggressively raise interest rates heading into the midterm elections, directly a direct affront to the president who put him in place to cut interest rates. If anybody believes that Kevin Warsh is going to be raising interest rates heading into the midterms when not one member of the FOMC voted to raise interest rates after we had a 4.2% headline CPI print, I think that's crazy. The worst case scenario for gold would be that the Fed doesn't do anything, because I don't think they're going to raise interest rates. That would obviously be the worst case, but I think the worst scenario is that the Fed does nothing, and the best scenario is that they start cutting rates towards the end of this year, because what I see is the rate of change of inflation is going to be going down, the second derivative, from 4%, 4.2 to around 3, maybe even a little lower. And that's based on five-year forward inflation expectations, CRB index, oil prices, money supply, Federal Reserve balance sheet growth. All those things tell me that we are going to have a lower rate of inflation. Now, let me be very specific, because sometimes people say I have an arcane way of speaking. The prices of goods and services will continue to rise. They're not going to go down. That's deflation. I'm speaking of disinflation. So the rate of change will be falling. That's it. That's all I'm saying. But when that happens, your investments have to change. So if growth and inflation are now slowing, as opposed to when everybody was on one side of the boat, everybody was saying, oh, Kevin, now all of a sudden the Fed has religion and they're going to now hike interest rates aggressively towards the end of this year, maybe 2 or 3 times. Not going to happen. So what gold loves more than anything is falling nominal rates and falling real interest rates. That's why sometimes people say, oh, gold's down when inflation's up, because if nominal rates are expected to rise, that's not good for gold, because gold is money that doesn't pay interest. Gold loves it when real interest rates are falling. And that's what I expect to happen. And I expect nominal rates to be falling too. And when you think about the miners, the energy they need to pull gold out of the ground is crashing from $120 a barrel back down to, we're actually in the 60s now, believe it or not. So, at least for now. So I doubled gold, physical gold, and I took a position in the miners. So I think it's great news. Now, let me just play this out too, if I hopefully don't interrupt myself again. So when and if we have a liquidity crisis, everything gets sold. That could happen, later on in 26 or 27. And that means gold will have a temporary, decline. But after that, when Warsh assents to the inevitability that he has to print trillions of dollars, then I think you're going to see gold shatter its all-time previous highs and go towards $10,000 an ounce. That's, if I could just, give you what my scenario is, because I think we're going to be, unfortunately, subject to intractable stagflation for a very, very long time. Slow, little to no real growth and higher rates of inflation as a direct response of the UBI and the TARP and the trillions of dollars that the Fed has to monetize on the other side of the next recession.
I think there's less pressure on the U.S. Fed to lower interest rates. I think ultimately they will, but I don't think they'll have to in calendar 2026. That means relatively strong U.S. dollar. That means that things that are denominated in U.S. dollars, like gold, will be soft in terms of price. I also think, and I'm making this next part up, David, so I hope you people don't take me too seriously, but I think the recent conflict that we had in the Gulf acted like a tax. And as you know, I think all taxes are bad. What happened with high oil prices is that we took a lot of liquidity out of the economy. And I think that the economy in the second half of 2026 is going to surprise people with its weakness. What that means is that I expect, as an example, the copper quote to be flat to down. I expect what you're seeing in the oil market, because the high oil price, among other things, killed some demand. So I suspect that 2026 is not going to be kind for people who are impatient. For people who are patient, I think that you're going to have the ability to buy names that are high quality names, that you're going to have enough time to study them before you buy them, and you're going to set yourself up to make a boatload of money in the out years. If I had to think about one thing that really scares me, that's it. You see a circumstance where if the Fed doesn't intervene, the interest rate wants to go higher. It wants to go higher. And higher interest rate does a couple things. It hampers the ability of stressed creditors to pay. If they had trouble at 7, they're going to have a lot of trouble at 9. And it also constricts credit. It also devalues the long bond, because that long bond can be replaced at a different interest yield. If you are already experiencing credit difficulties, higher interest rates are difficult for you. In answer to your specific question, what scares me is the high yield ETFs, the junk bond, or the subprime credit ETFs have literally trillions of dollars of assets, and many of them are owned by people who don't understand the credit risk that they're taking. If people begin to have credit concerns and begin to sell those ETFs, the ETF structure itself is highly liquid, but the assets in the ETFs aren't liquid. The manager will have to sell assets which he or she can't sell to fund redemptions, which they must fund. That's where the run on the bank comes. There are some high-yield bonds that were sold over the counter in these ETFs that trade once every 6 weeks. If you have to push that bond into the market overnight to fund a redemption, the price that you're going to sell that bond for is going to reflect your distress, not just the market's distress. And that really scares me. Really, truly scares me. I'm afraid that many retail investors don't understand the risks that they're running in their high-yield bond portfolio. They don't understand the credits that they're writing. And if something happens like 2008 that causes them to be concerned, if they head for the exits, there's no exit.
Moving deeper into the underlying mechanics of the credit markets, a hidden vulnerability looms within highly popular investment products. Trillions of dollars remain concentrated in high-yield and subprime credit ETFs, which are heavily owned by retail investors who often do not fully comprehend the underlying liquidity risks. While the overarching ETF vehicles offer instantaneous liquidity to buyers and sellers, The actual distressed corporate bonds held inside those funds are notoriously illiquid. If a sudden market shock triggers widespread panic, a dangerous structural bottleneck occurs where fund managers are forced to dump assets into an inactive market overnight to meet immediate investor redemptions. This friction threatens to spark a localized run on the credit system, causing asset prices to crash violently and reflecting severe institutional distress rather than fair market value. For those seeking long-term stability, patience remains the ultimate competitive advantage, as the second half of 2026 is predicted to reveal deep economic weakness, dragging copper prices down and leaving broader commodity quotes completely flat. Now, let's get back to the interview.
In 2008, the aggregate debt of the U.S. federal government was about 40% of GDP. Now it's 120% of GDP. One wonders about the tools available. The Fed was able to say in 2008, we will do whatever it takes. The market might now look at the Fed and say, you don't have the ability to do what it takes. You can't raise taxes. You can't increase the deficit. So if you bail out the system, you have to print. And if you print, that's going to be wildly inflationary, not merely inflationary. So the ability that the Fed has to intervene relative to the size of the problem is much lower now than it was in 2008. I'm not saying that they can't. And if it happens, they will. But the damage that they do to business confidence, to credit confidence, and in particular, to confidence in the sanctity of the U.S. dollar is very, very risky. The interest rate wants to go up.
Yes.
And the government is doing whatever they can by buying the long end of the yield curve and financing it out of the short end of the yield curve. They're doing whatever they can to maintain their control over the yield curve. Right now, because people are concerned about the broad economy, there's a lot of people, myself included, who are willing to buy one-year paper. The government is financing one-year paper to buy back 10-year paper to lower the long bond yield. But the long bond yields are still rising. What that's telling you is that investors want a time premium and they want a risk premium. If we have a market, a panic-engendered market, you'll just have to see what's cheaper. When I look across the opportunities that are presented to me, the opportunity that's most attractive to me, probably because I know it very well, is the gold stock market. The gold stocks are, relative to the gold price, not cheap, but they're fairly priced. And they've been fairly priced maybe 4 times in my career. I believe, make no mistake, that over 10 years, the gold price, the nominal gold price, is going to be markedly higher than it is today. And I think the fact that I'm able to buy high-quality companies at fair prices in a market that I think gets inexorably better is very attractive. I think right now that the oil quote and the oil stocks are in free fall. And the oil market is a better market than any other natural resource stock. So if I looked at what I'm likely to allocate to the most over the next 6 months, it's likely to be the oil and gas business. I'm able to do that because I know a lot about it. I grew up in that.
12 monkeys that get elected to serve on the Federal Open Market Committee, like the 12 apostles, they should never have the right to not only, repress interest rates, send them artificially lower, decade after decade after decade, which is happening really since the 80s, but really became salient and prevalent after the year 2000. But they also control the amount of money that is in the system. They manipulate money supply by printing credit.
Yeah.
And when you heavily influence the supply, the broader monetary aggregates, and the cost of money, everything else gets deformed. The savings and investment dynamic gets blown to pieces. Asset prices get blown up. The middle class gets eviscerated, and it all lands at the government, the Treasury and the Fed. The Treasury spends too much. They borrow too much. The Fed facilitates that by keeping interest rates low. And what we've done is we've gone from a regime of let's just loan banks money overnight in something called a discount window, treasuries for credit at a discount. That was not the 1913 construct of the Federal Reserve, to let's cancel recessions. Let's keep the unemployment rate from ever ticking up, and let's prevent the stock market from ever having a downtick. That's the new dual mandate of the Federal Reserve is perpetual bull markets in stocks, and never to have a recession. Because you know why, Daryl? And I'll just, this is very simple. It's a fact. They know that the level of over-financialization of the economy and the extent at which asset bubbles are prevalent now, that when we have a recession and they have not abrogated the business cycle, we will have a recession. It will happen. They're doing their best to hold it at bay by printing trillions of dollars, but it'll happen. When it happens, it will not be a recession. It will be a depression. And since the government's balance sheet has been so severely impaired during the last two recessions, or actually the last three recessions, so 2000, 2008, and 2020, the government's balance sheet has been so overextended that it won't be able to easily rescue us the next time. 3 strikes, you're out.
The structural safety nets that historically shielded the broader financial system from total collapse have become dangerously fragile. During the peak of the 2008 global financial crisis, the aggregate U.S. federal debt sat at a manageable 40% of GDP, giving the Federal Reserve ample leverage to deploy an aggressive whatever-it-takes rescue strategy. Today, sovereign debt towers at a massive 120% of GDP, severely limiting the fiscal and monetary tools available to combat an impending economic downturn. Financial experts predict that the U.S. Federal Reserve will face less immediate pressure to drop interest rates through the remainder of 2026, which will temporarily sustain a strong U.S. dollar and keep dollar-denominated assets like gold soft in the near term. However, because the central bank has spent decades repressing interest rates and aggressively blowing up asset bubbles to cancel the natural business cycle, the next inevitable recession is predicted to manifest not as a standard contraction, but as a full-scale depression. When the system eventually fractures under the weight of high interest rates, the government will have no choice but to print trillions of dollars, triggering wild inflation and eviscerating business confidence entirely. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.